Hello, this is the 20th episode of What Would Peter Lynch Do that explores the wisdom of legendary investor Peter Lynch. Why do companies do IPOs? Is it a good idea to invest in companies that are IPOing? They've gone up a lot. Today, our mission for this deep dive is, well, to really unpack the fascinating and, let's be honest, often confusing world of initial public offerings, IPOs, and we'll be filtering everything through the incredibly insightful lens of Peter Lynch's timeless wisdom using the sources you've provided.
It's true, isn't it? There's so much buzz, so much excitement around IPOs, especially if you're starting out in investing. It can feel like this golden ticket, maybe a guaranteed path to quick wealth.
Yeah, exactly.
But the reality is we'll sort of dig into today is far more nuanced. We're going to try and cut through that noise, that excitement, and really break down what's happening behind the scenes so you can, well, much more informed decisions.
Absolutely. So let's start right at the beginning. What is an IPO? We hear the term thrown around all the time, but, for someone new to the stock market, it can feel a bit abstract.
Okay, yeah. Simply put, an IPO is when a private company decides to publicly sell its shares, its stock, for the very first time on a stock market. Think of it like this, maybe. Imagine you've poured your heart and soul into creating this amazing, incredibly popular pizza place in your neighborhood. It's doing great.
Okay, like a local favorite.
Exactly. It's so successful you start dreaming bigger, expanding it nationwide, maybe even globally, right? A huge franchise. But that kind of expansion takes, well, enormous amounts of money.
Right, you'd need serious cash. Hundreds of millions, probably.
Easily. We're talking potentially billions for a global pizza empire.
Yeah.
So, to get that capital, the owners announced to the world, hey, we're going to sell ownership stakes shares in our pizza place to anyone who wants to invest.
Ah, okay. So they're selling off little pieces of the company.
Precisely. This act of publicly offering shares of your pizza place for sale to the general public, for the first time ever, that's what an IPO is all about. And through this, your pizza place officially transforms from a private company into a public company.
Got it. And once it goes public, where do these shares actually get traded here in the U.S.? Are there specific places?
Yep. In the U.S., there are two main stock exchanges where these companies typically list their shares. First, you have the New York Stock Exchange, the NYSE. It's known for listing, larger, more established corporations.
Yeah, big name.
The big names, often with very strict requirements. It's kind of a cornerstone of Wall Street. Then there's NASDAQ. NASDAQ is, well, it's famous for its focus on high-tech, high-growth companies.
Yeah.
Think Apple, Microsoft, Google.
Ah, the tech giants.
Right. They all trade on NASDAQ. It's a very popular choice for companies looking for rapid expansion and maybe tapping into that growth-oriented investor base.
Okay, that clarifies the what and where. But let's unpack the why. Why would a company, even our super successful pizza place, go through such a complex and, frankly, public process? It sounds like a huge undertaking.
It really is. It's a massive effort, but the reasons are very compelling for the companies. The most crucial reason, the primary driving force usually is capital raising.
Getting that money we talked about.
Exactly. The U.S. market is the world's largest, most liquid capital market. An IPO lets a company secure a substantial amount of money, often hundreds of millions, sometimes billions of dollars, to fund really ambitious projects, like that global expansion, or investing in cutting-edge new tech, or even buying other companies to grow even faster.
So it's basically fuel for massive growth.
Oh,
What else? Are there other big benefits?
oh yeah. Another key reason is providing liquidity for early investors. Think about the people who put money in way back when the company was just starting: venture capitalists, angel investors, maybe even the founders themselves.
The ones who took the early risk.
Right? They can finally sell their shares in the public market through the IPO and hopefully realize significant profits. Imagine your friend who gave you, say, $100,000 for your pizza place when it was just a tiny startup.
Sure.
If it goes public and becomes a huge success, they could sell those shares for much, much more. It's their chance to finally cash out on that initial bet.
That makes perfect sense, rewarding that early foresight and risk.
Exactly. Then there's enhanced visibility and brand image. Getting listed on a major U.S. exchange like the NYSE or NASDAQ brings a company global attention. It significantly boosts its recognition and credibility.
Right. Suddenly, everyone's heard of your pizza place.
Yeah, if your pizza place is suddenly listed on NASDAQ, people around the world take notice. They think, wow, that must be a serious, impressive company. It provides this huge promotional effect that a private company just couldn't achieve on its own.
And I bet that increased visibility also helps them hire people, right? Top talent.
Absolutely. That's the final key reason, really, to attract and retain talent. Public companies can offer employees things like stock options or restricted stock units, RSUs. These give employees a direct stake in the company's future success.
So they feel like owners, too.
Kind of, yeah. It's a crucial strategy, especially in highly competitive sectors like tech, to attract the best people and keep them motivated for the long haul.
Okay, so those are some pretty compelling advantages for the company. But it can't all be positive. There must be some downsides, some trade-offs involved in going public.
Oh, absolutely. You're right. There are significant trade-offs.
Yep.
On the disadvantage side, well, first, there are substantial costs and time. Preparing for and completing an IPO involves huge legal fees, accounting fees, investment bank fees. It's expensive. And the whole process can take many months, sometimes even years.
Wow, years.
Okay.
Yeah.
Then, once you are public, you face strict regulations and disclosure obligations. Companies have to comply with the U.S. Securities and Exchange Commission, the SEC's rules. This means constantly releasing highly detailed information to the public.
Like what kind of information?
Things like quarterly and annual financial reports, details about how much executives are paid, the status of their internal controls. Sometimes this info can even be commercially sensitive. It's a huge burden and risks exposing valuable stuff to competitors.
So a lot less privacy for their secret pizza recipe, so to speak.
Exactly. And that transparency leads to another thing: constraints on management control and external pressure. As ownership gets spread out among many shareholders, those external shareholders can start exerting more influence on management's decisions.
So the original owners might lose some control?
They definitely share control. And companies might feel pressured to deliver strong short-term results, quarter after quarter, sometimes even if it conflicts with their long-term strategic vision. And finally, there's stock price volatility risk.
Meaning the price can swing wildly.
Yeah. If our pizza place went public and suddenly, say, the price of flour skyrocketed, or a competitor launched some amazing new pizza that hurt sales, well, your stock price could plummet. This affects the company's image, and management has to spend time managing shareholder expectations, explaining performance. It adds another layer of pressure.
It really sounds like a lot of responsibility. So who even qualifies to do an IPO in the U.S.? It can't be just any local pizza shop, right? No matter how good the pepperoni is.
You're absolutely right. It's not just any company. The NYSE and NASDAQ have their own specific requirements, but the core principles are pretty strict. First, they look hard at a company's financial health and size.
Okay, like how much money they make.
Yeah, companies usually need to show consistent income or profitability over a certain period, like being profitable for 2 out of the last 3 years is a common benchmark. But NASDAQ, which focuses on growth, also offers alternatives.
Alternatives, how so?
Well, if a company isn't profitable yet but has really high revenue or a very large market capitalization, basically, a high total value, they might still qualify. They also look at total revenue over a specific period and a company's overall equity, its book value.
So it's not just about profits now, but also proving you're financially solid, or at least showing like immense potential for future growth.
Exactly. Then there are liquidity requirements. This is about making sure the stock can actually trade actively once it lists.
What does that involve?
It refers to the number of shares that will be available to the general public, that's called the public float, and also the total number of shareholders. These numbers have to meet certain minimums. They need enough shares out there spread among enough people so there's a market. Also, the share price at listing usually has to be above a certain level, like NASDAQ often requires $4 or $5 per share.
Okay, keep the price from being too low initially.
Right. And finally, there are strict governance and other requirements. This is about how the company is run.
Like having a proper board.
Exactly. Things like having independent board members, setting up an audit committee, having robust accounting and internal control systems complying with laws like the Sarbanes-Oxley Act. And of course, the company has to be ready to transparently and accurately disclose all the necessary information to investors.
So for a pizza place to get listed on NASDAQ, it's way beyond just delicious pizza. You need to show consistent revenue, maybe profit, or if not, demonstrate huge growth potential, and prove your management is transparent and follows strict procedures. That really clarifies who qualifies.
It's a very comprehensive vetting process, definitely.
Okay, here's where it gets really interesting for a lot of people listening. How does a company actually do an IPO? It's not just, flipping a switch, is it? It sounds incredibly complicated.
It is indeed very complex, very time-consuming. It typically starts with investment bank selection and engagement. The company hires one or more big investment banks, names like Goldman Sachs, Morgan Stanley, to act as underwriters.
Underwriters, what do they do?
They basically manage the entire IPO process. They advise the company, prepare the documents, and handle the actual sale of the shares. Think of it as our pizza place owners hiring a specialized Wall Street banker, an expert in taking companies public.
Got it. Like a super-powered financial guide through this whole maze. Then what happens?
Next comes due diligence and internal preparation. This is intense. A whole team of experts, of bankers, specialized lawyers, accounting firms, thoroughly investigates everything about the company. Pretty much. Financial health, business model, any legal risks, the management team's experience. They comb through it all. At the same time, the company itself has to set up those transparent accounting systems and internal controls required for a public entity. The bankers team will meticulously examine, all the pizza place's ledgers, its contracts, even its recipes and operations to get everything ready for public disclosure.
So they dig really deep to make sure everything is absolutely in order and above board before going public. What's the next big step after that deep dive?
That's when they file the S-1 registration statement with the U.S. Securities and Exchange Commission, the SEC. This document, it's huge, usually hundreds of pages long.
Hundreds.
Yeah. And it contains all the detailed information potential investors need. Company operations, financials, who the managers are, how much money they want to raise, even an estimated price range for the shares. The SEC reviews it, asks questions, the company revises it, until finally, hopefully, it gets approved. It's basically like submitting this incredibly thick book all about your pizza place to the SEC and asking, please, can we be listed on the stock market?
An entire book just to apply. That's intense. What happens while they're waiting for the SEC's okay? Or after they get it?
That leads into the roadshow and book building phase. This is pretty interesting. The company's top management and the underwriting bankers travel around, hitting major cities globally.
Like a tour.
Exactly, a roadshow. They meet with potential large institutional investors. Think big asset managers, hedge funds, pension funds. They give presentations, introduce the company, trying to drum up investment interest. And crucially, they gauge how much interest there is, how many shares these big players might want to buy.
To figure out the price.
Precisely. Based on those investor reactions and their indications of interest, the bankers determine the final offering price for the shares. So you can imagine the pizza place owners traveling to New York, London, Singapore, presenting to these wealthy investors saying, please buy our pizza place shares. It's going to be huge.
And once that offering price is finally set, what then?
Then the shares are allocated to investors. Now, this is key. Primarily, these shares go to those large institutional investors who committed during the roadshow. And this is where it gets particularly challenging for individual investors like you and me.
How so?
Well, general individual investors typically receive very little, if any, direct IPO allocation at that initial offering price. Sometimes, maybe a very limited opportunity might be offered to certain VIP clients of large brokerage firms. But most of our pizza places shares, they'd be sold first to these big money institutional investors. Only a tiny fraction, if any at all, might be left over for the general public through other channels.
Okay, so for us, the individual investors listening, can we actually get in on this action before the price potentially surges? Can we pre-subscribe, that you sometimes hear about in other countries?
Honestly, to be direct, it is very difficult for a typical individual investor to pre-subscribe to U.S. IPO shares at the offering price. The U.S. system is quite different from, say, the public offering subscription system in Korea.
Right.
The core of U.S. IPOs is really an institutional investor-centric allocation. The investment banks, the underwriters, have a lot of discretion over who gets those initial shares, and they primarily allocate most of them to major institutional investors, hedge funds, pension funds, mutual funds.
Why them specifically?
Because these big players buy large quantities, millions of dollars worth, and they often tend to hold for the longer term. This helps create a stable demand base for the stock right from the start. It's like the biggest buyers, the ones who can invest huge sums, they get the best seats and buy on the most favorable terms first.
So the big institutions get first dibs on the potentially best deals. What about other groups?
Well, some shares also go to the underwriters' VIP clients. These are usually very high net worth individuals who are top customers of the investment bank or its affiliated brokerage firms.
People with a lot of money invested already.
Exactly. They get preferential treatment
Right.
because they do large transactions or pay significant fees. It's kind of like the bank selling our pizza place shares saying, okay, we're offering this special pre-purchase opportunity, but only to our VVIP clients who've entrusted us with substantial assets.
Okay, so what about accessibility for the everyday individual investor? Is it completely shut off, or are there any avenues?
Not completely shut off, but still very challenging. Some of the large online brokerage firms like Fidelity, Charles Schwab, maybe even Robinhood, they do offer small IPO allocations through programs sometimes called IPO access.
Okay, IPO access.
Yeah, but there are usually significant hurdles. These programs often require you to hold a certain amount of assets. With the brokerage, we're talking tens of thousands of dollars, maybe even hundreds of thousands or more. Or you might need to be a long-time, very active trading client.
So not for casual investors usually.
Often not. And in some cases, you might even need to meet the official accredited investor requirements. In the U.S., that generally means having an annual income over $200,000 or a net worth over $1 million, excluding your primary home.
Wow. Okay. That rules out a lot of people.
It does. And even if you do qualify for one of these programs, allocation isn't guaranteed at all. It's often done by lottery, like a random drawing, or based on the brokerage's own internal logic. You might request 100 shares and get 10 or none. It's like the brokerage saying, okay, among our qualifying VIP clients, we'll randomly select just 100 people to offer these pizza place shares. The odds are typically very low for popular IPOs.
I see. And I know some listeners might be aware of Korean brokerage firms offering services for U.S. IPOs. Does that change things much?
Well, they act as intermediaries, but they face the same constraints. Their ability to get shares depends entirely on what allocations their U.S. partners receive, which, again, are usually very limited for hot IPOs. Plus, they often charge additional fees for that service. So it doesn't really solve the fundamental access problem for most people.
Okay, so the bottom line is getting in at the ground floor price is tough for individuals, which leads to the next question. Why do we constantly hear about these IPOs that just explode on day one, and people only seem to participate after that huge surge?
Right. This is a classic characteristic of the U.S. IPO market. What often happens is that hot IPOs, the ones with significant institutional investor interest during that book building phase, they often begin trading at a much higher price on the listing day, sometimes significantly higher than the official offering price.
So even the first trade is way up.
Often, yeah. For example, the offering price for our pizza place shares might be set at $20. But because it's super popular, the very first trade when the market opens might be at $30 or $40 or even higher. It just jumps immediately.
So it's already popped before most of us even get a chance to click buy.
Precisely. There's a reason for this. Underwriters tend to price IPOs slightly below what they think the market demand will actually bear. It's partly intentional.
Why would they do that?
Well, it helps ensure a successful offering that all the shares get sold, and aims to provide an immediate paper profit to those early institutional investors and VIPs who did get shares at the offering price. That makes them happy, builds goodwill, and also helps with future stock sales and boosts the company's public image right out of the gate. This immediate price increase right after listing. That's what people call the IPO pop.
The IPO pop, okay.
And the reality for most individual investors is they can only start buying shares after the stock officially begins trading on the exchange at that already surged price post-pop.
Okay, that explains the pop. So it sounds like you often end up buying after that initial jump, but then do all U.S. IPO stocks just keep going up and up after that surge? Is it the guaranteed win that, the hype sometimes suggests?
No, absolutely not. It is definitely not true that all U.S. IPO stocks explode and keep rising indefinitely. That's a dangerous misconception.
Okay.
While IPOs certainly offer the potential for high returns, that's the allure, they're also inherently a field with significant risks. It's high risk, high return. Not all IPOs succeed, and actually, many even decline immediately after listing or shortly thereafter.
So the pop isn't a guarantee of future success?
Not at all. The IPO pop is quite common, yes.
Mm-hmm.
In really strong bull markets like 2020, the average first-day return was incredibly high, maybe around 36% on average. But that initial surge doesn't guarantee long-term success. It's mostly driven by that initial mismatch between offering price and immediate market demand, plus that institutional interest. After day one, the stock price starts moving based on a whole host of other factors: the company's actual performance, broader economic conditions, market sentiment.
So that initial pop is just that it's initial. It doesn't tell the whole story about where the stock is headed long term.
Exactly. In fact, studies have shown that roughly 1/3 of IPOs actually close below their offering price on the very first day of trading. These are sometimes called broken IPOs.
A third. Wow.
Yeah. And nearly half can trade below their offering price by the second day. If you look at the average trends over longer periods, U.S. IPO stocks show very high volatility right after listing. And while a few massive winners, the next Google or Amazon, tend to pull up the overall average return significantly, many other IPOs actually underperform the broader stock market index, like the S&P 500, or even result in losses for investors over the medium to long term, say 3 to 5 years out.
So the average is skewed by a few huge successes.
Just exactly. Excessive market expectations or initial overvaluations tend to correct themselves eventually. For example, IPOs from, say, 2012 to 2021 might have shown high average first-day returns, but their average returns after holding for 3 or 5 years were often quite low, sometimes even negative, compared to just putting your money in a broad market index fund. It really illustrates how a few big winners can easily distort the overall picture for investors looking at averages. Blind investing based on IPO hype is, well, it's just forbidden territory.
Okay, so if that initial pop isn't the reliable indicator, what really determines if an IPO turns out to be a long-term winner or, a bust? What should we actually be looking at?
Right. The single most crucial factor really comes down to company fundamentals. Does the company have genuinely innovative technology or a unique product? Does it have a sustainable growth model? Are its financials healthy or at least on a clear path to profitability? And is there a competent, trustworthy management team leading the way?
So back to our pizza place.
Yeah, for our pizza place, it needs to consistently introduce popular new menu items, keep its customers happy, manage costs effectively, and ultimately generate real profits. It can't just rely on the initial excitement of going public. That fades.
Makes sense. What else matters?
Then you absolutely need to consider the industry trends and the competitive landscape. Is the industry itself growing? Does this company have clear, durable advantages over its competitors? Also, macroeconomic conditions play a huge role. Things like rising interest rates, inflation, recession fears. These can quickly sour sentiment towards growth stocks, including recent IPOs.
And the initial price itself must matter too.
Definitely. Valuation is key. Even if it's a great company, if the offering price is simply too high, based on its current earnings or realistic future prospects, investors might deem it expensive. That can lead to underperformance or even a price drop later on, regardless of the initial pop. And finally, never underestimate market sentiment.
Meaning hype and fear.
Exactly. Greed and fear drive markets in the short term. Sometimes speculative bubbles form around certain sectors, think AI recently, or electric vehicles a couple of years ago. These can push IPO prices far beyond any rational measure of their real value, setting investors up for disappointment when sentiment inevitably shifts. Thorough study is absolutely crucial.
This all reminds me so much of a big warning sign Peter Lynch often talked about, especially when there's an IPO boom and suddenly everyone seems to be talking about getting rich quick from these new stocks. What did he say about that kind of environment?
That's a very valid observation, and it's precisely the kind of thing Peter Lynch flagged as a huge warning sign, often a sign of a speculative bubble or an overheated market. When you suddenly see a boom in IPOs and stories are flying around about ordinary people making tons of money very quickly, that's often a signal that things are getting frothy.
Why is that such a danger sign?
Well, a few reasons. First, the fear of missing out, FOMO, spreads like crazy. People hear rumors, maybe their neighbor hit the jackpot with some IPO stock, and even folks who normally have zero interest in stocks suddenly feel this pressure to rush in. They think, I don't even know what this company does, but everyone else is making money, so I should buy it too.
Yeah, that irrational herd mentality.
Exactly. And that leads directly to irrational exuberance and often severe overvaluation. You might see a small, newly public pizza place suddenly being valued like it's the next McDonald's, based purely on vague hopes and dreams, not actual performance.
So that high first-day pop we talked about might actually just be masking huge risks down the road, especially for individual investors who jump in later at those inflated prices.
Precisely. The dot-com bubble back in the early 2000s is the classic, painful example. You had internet companies with maybe no profits, sometimes barely any revenue, going public with enormous valuations. They surged immediately because of the hype. But when that bubble inevitably burst, most of those stock prices just plummeted, wiping out tons of investors. It creates this dangerous illusion of easy money. Investors can become complacent, they stop doing their homework, they stop analyzing the actual company and managing risk properly. Investing basically turns into gambling. And frankly, it also encourages companies that maybe aren't financially robust or ready for the public markets to rush their listings just to try and cash in on the hype and secure those high valuations while they can.
So given all that, what was Peter Lynch's specific direct advice for individual investors caught up in or tempted by this kind of IPO frenzy?
Peter Lynch was famously very cautious about IPOs. He didn't mince words. He'd even describe them flat out as terrible investments for individual investors. His core advice was blunt. Avoid IPOs if you can.
Avoid them altogether. Wow.
Yeah, that was his general stance for the average person. He firmly believed that by the time a general investor could actually get their hands on IPO shares, the institutions and insiders had likely already secured shares at a price designed to give them an immediate profit, that IPO pop. He actually saw the pop as detrimental to long-term individual investors because it often sets an artificially high entry point right from the start.
Because it's driven by that initial hype and allocation strategy, not necessarily the company's real underlying value at that moment.
Exactly. He really hammered home the issue of information asymmetry. He pointed out that the investment banks, the underwriters, and the big institutional investors have access to far more detailed information and conduct extensive due diligence. Whereas general individual investors, they often rely on limited public filings and, let's face it, sometimes exaggerated marketing materials from the company or the banks.
So the playing field isn't level.
Not even close, in his view. He specifically warned investors not to be swayed by those short-term price surges, that IPO pop. He saw them as largely speculative, often inflated by temporary sentiment, not a true reflection of the company's fundamental value or long-term prospects. And he backed this up by pointing out that historically, many IPOs actually underperform the overall market within just a few years of going public.
So don't just chase the new shiny object.
Precisely. He applied his most famous principle here: invest in what you know. He cautioned investors strongly against just buying a new stock simply because it's new and generating buzz, without taking the time to really understand the newly listed company's business model, its competitive strengths and weaknesses, its financial health, its management. He believed it was far wiser to sit back and observe the company's performance for a sufficient period after it had already listed and started trading publicly. Let the dust settle, basically.
They let the hype die down and see how they actually perform as a public company.
Exactly. Let them issue a few quarterly reports, see how management handles challenges, get a real feel for the business after the IPO spotlight fades. He also stressed that only a very small fraction of IPOs turn out to be truly successful long-term investments. Many more fail or languish. He noted that those few huge successes often make the overall IPO market's average returns look favorable, but investing in any individual IPO is inherently very risky without doing that thorough, independent analysis first.
So to sum up Lynch's view,
In essence, Peter Lynch viewed IPOs as a very dangerous playground for individual investors. His primary advice was to avoid them if possible. And if you absolutely felt compelled to invest in a recent IPO, do so with extreme caution, and only after you've done your homework and confirmed the company's real value and sustained performance after it's been trading publicly for some time. Don't get caught up in the initial frenzy.
this deep dive has really been eye-opening. It shows that when it comes to IPOs, that initial excitement, that pop, it's often just the beginning of a story and definitely not the whole story. Peter Lynch's caution really resonates here.
It does. And if we connect this to the bigger picture, maybe pull out a word from Peter Lynch today. His caution against being swayed by short-term hype, his demand for thorough understanding before investing, and his focus on prioritizing fundamental long-term value. Well, that principle isn't just about investment decisions, is it? It really applies as a kind of life wisdom, too.
How so?
It's about looking beyond the immediate pop, whether that's in stocks or career choices or even relationships, and really trying to understand the true underlying long-term substance before you commit. Don't just chase the fleeting excitement. Look for genuine, sustainable value.
That's a great way to frame it. Looking beyond the pop. See you next time.
This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.